Let's just begin this discussion to understand how is real estate really poised at a time when NBFC is in a crisis mode. Let me begin with the developer then. So, have you seen panic situation already set in? Is there any pain seen for a developer in accessing funds at the moment?
Yes, Sunisha, it's very true that the recent crisis has, triggered a word of caution in the NBFCs. And I think this will stride over, it's a matter of maximum a couple of months that we'll stride over this crisis. But having said that, friends, I can tell you one thing, that even today, in these circumstances, there is money available for certain category of developers. So it's not a big no-no. But yes, caution definitely. Yeah.
All right, so there is caution. Amar, coming to you, help us understand how deep is the problem in the NBFC space and how long before we see some sort of resolution to the present situation?
Difficult questions, but I guess all of us are, we don't have much of information at this point because it's all very recent and happenings are happening on a daily or a weekly basis. So I think the problem has arisen because of a few factors that have been at play for the last 2 to 3 years. The first factor being aggressive underwriting and aggressive growth done by NBFCs and HFCs to grow their loan books at any cost, and therefore asset quality takes a backseat in such a scenario. And this is not the first time. We have seen this happening every cycle. However, what's happened this time in addition to that is that NBFCs have been aggressively funded on the debt side by banks and by mutual funds. And this kind of funding has happened across the maturity profile, which is in the short term as well as the long term bucket. So NBFCs and HFCs that have funded their growth with short-term liabilities that have funded long-term assets are in for a significant problem because of the asset liability mismatch. And it's not fair, I think, to paint all the NBFCs with a single brush, because there are NBFCs and HFCs who have and continue to manage their business very well. So for example, talking about ourselves as Xander, we have never ever borrowed short-term money for long-term purposes. We don't have a single CP program in spite of having the CP rating at the highest level. So it depends on how you're organizing your business, how you're running your business. But yeah, this problem is expected to continue for some more time. There is some more pain left.
So Amit, coming to you, how do you see this situation, and will it lead to consolidation? But before that, are we going to go through a lot of pain before that happens?
I think it's early days to actually predict the outcome of the recent events, Nisha, for sure. But I certainly believe, and this has been my belief for the past couple of years as well, to what Amar pointed out, that the growth has been breakneck by NBFCs and HFCs, which obviously may come at a certain cost to the industry at large, because the entire interest rate cycle hadn't dipped to the extent at which the real lending rates dipped. So clearly, I think there was a lot of leverage which was being taken, and the spreads were getting compressed in the hands of the lenders. So clearly the margins available for risk in their books was very small. And as a fund, we don't have leverage, and that was obviously a challenge for us, because we could not continue to offer lower rates beyond a certain period of time, because we believe that on a risk-adjusted basis, there was a certain commensurate return that a private equity investor or a fund must deserve. And therefore, there was a little bit of a gap that kept on emerging over the last couple of years. So I think, maybe it's a healthy thing, because I think it's cyclical in nature, and once that cycle matures, and I think maybe now the cycle will mature, where there will be more sanity, in terms of the credit risk and the profile that is being seen, as well as the risk-adjusted returns. So if you're lending to a fantastic counterparty like Mr. Mohanani is on the panel, then you have no worry. But the problem was that everybody was being seen on the same scale, and there was a fight for volumes, at the cost of risk, which was getting embedded in the books. So clearly, I think that problem will solve itself out, and I think leading to that question on consolidation, I think it's consolidation across the board, across stakeholders. So yesterday we talked about developer consolidation. I think there will also be financial consolidation, and there will also be therefore more sanity, both on the demand side and the supply side of capital.
Right. So,
just on consolidation, maybe about 3 to 6 months back, till that point, HFCs, the HFCs, the number of licensed HFCs is a pretty high number, and the valuations of HFCs were sky high and rocketing high. But in the last 2 months to 3 months, the valuations of HFCs that are available as potential sellers have actually corrected quite a bit. And I think this will be one more trigger for a down rating on valuation on HFCs and even NBFCs.
I think equity markets are on their own taking care of that at the moment, and we'll have to see how this really develops. But right now, while NBFCs are in a tizzy, are the banks going to really play a supporting role when it comes to real estate funding? So Sanjeev, coming to you then, how are banks poised, and do they still see real estate funding at this point as risky, or will they be supportive?
There should not be any fear, there should not be any risk. As far as the credit risk is concerned, there is no issue. Banks continue to lend to NBFCs, and banks have quite a good headroom to, further their lending. They have their sectoral caps, individual company-wise exposure limits in place, within which they operate and extend the credit.
But cost of fund is something that is going to be on the higher side.
So that, the cost of funds is always relative. Cost of funds is relative to two things. What it was before. If before it was higher, so now it would be lower. If before it was lower, so now it is higher. And it moves in a cycle. That is second thing. Third thing is, at what rate are you able to lend? So it is actually the net interest income or the net interest margin which actually needs to be looked at instead of looking at cost of funds. If I am able to make good NIM, good net interest margin, then I should not be largely bothered about the cost of funds.
All right, so let me take it to the mutual fund view then. A lot of what happened in NBFC also got triggered because of mutual funds stalling, especially the commercial papers coming in light. Now, how do you see at this point the way mutual funds will behave? Is there caution and complete freeze on NBFC lending for a very long time?
Very long time is difficult to predict. But having said that, I think there is a situation which is very recent. And we are, every mutual fund or every institution in the country is in a more of wait and watch mode. So they are actually evaluating it. But I think fundamentally, if you look at it, the funding options to NBFCs, whether it is from mutual funds or as Sanjeev ji said, even from banks, will continue to be in place. So if you actually analyze the industry, roughly we have about $63 odd billion of real estate credit. Out of that, there has been a definite increase by AIFs as well as by NBFCs. I mean, it has jumped from 30% earlier to 60% now in the last 4 years. So there has been substantial jump. And from a mutual fund perspective, wherever the fundamental of the business of any NBFC is in there, they are in the business of lending. So they would basically go ahead and issue those commercial papers or give those lending. So I don't think that's going away at any point of time. A lot of those companies which are backed by corporates, be it Birla, be it Tatas, we have Zender with us, we have Art with us. So I think from those perspectives where the business model, where they're clear what they want to do, I would say they are more clear what they do not want to do. So once you have a clarity what you do not want to do, are something where your focus comes in, and those are the institutions which will continue to attract capital.
Let me come to the affordable housing segment and the lender to that. So, Arvind, how do you see the impact? At the moment, have you started seeing signs, and how do you assess the situation?
Yes, as far as affordable housing is concerned, I think there is enough focus from the government as well as the regulator, NHB, as well as the prime lending institutions which are available today in the market. There is enough and more happening on the demand side, and we think that these are all, temporary hiccups, and that business is there for the taking, and I don't think that in the long run there will be any issue as far as liquidity for affordable housing is concerned.
Ashoka, how good is bank lending as far as real estate is concerned? Can you depend on that in the absence of NBFC?
Actually, yes and no. Yeah, for construction finance, they're always available. But when there are so many different kind of structures these days. We have to architect our structure. So it could be a development management agreement, it could be a joint venture, it could be good sharing. So in such cases, we don't have much of option. We need to go to NBFCs who, having a leaner team, they are able to understand, our issues, and there are resolutions, to our issues. Moreover, the relationship between most of the NBFCs and developers is like a partnership. It's more like a, you can treat them like a family doctor, because you have to be very transparent with them. And this way, they not only they get comfort out of the developers, but they also, get themselves involved as partners and work out solutions for us.
Right. So Sanjeev, you want to come in on this, that bank funding when it comes to real estate, that is restrictive in nature because of also the sectoral caps and then RBI's regulations. So how do you assess that, and is that also good in terms of disciplining the banks when it comes to funding in the sector?
If I may say that if a builder needs a loan, we have good schemes for him, but they are construction linked. We also give him loan against the property. So there are various schemes by which we can cover the requirements of the builders, or similarly for NBFCs. Those options are available within the framework.
So Amit, do you agree that there could be a little more regulatory tightening when it comes to NBFCs after we have passed this situation? And regulators could tighten and bring in some of the banking regulations and those discipline to NBFCs as well, and that could impact real estate funding?
NBFC industry is very young, Nisha. We've seen NBFCs really come out and grow only in the last 5 years. For an industry which is still just 5 years old, to already start over-regulating or pondering over it is too early. In fact, the biggest challenge for RBI now is the plethora of NBFC applications which is sitting on its desk. I think they're still trying to figure out how to clear those rather than wondering about how to regulate them already. So I think the challenge is not at the RBI level, and neither is the challenge at the SEBI level for funds. I think the challenge is really assessing credit quality today. I think there's been indiscriminate capital disbursements by everybody. I'm not saying that funds haven't done it or NBFCs haven't done it, because there was a rush to replace capital or put capital into products and solutions which otherwise banks were unable to do for various reasons, as Sanjeev rightly pointed out. Having said that, I don't think it's either or. I don't think we can do what the banks can do. I think the efficiency and the cost of capital and the ability of banks to do construction finance is next to none. Right. I don't think any of us can compete with that. And clearly, I think the most deserving developers today have not even gone to the NBFC doors if they needed construction finance. They squarely and continue to squarely rely on the banking sector. And I think that's very critical. As Ashokji rightly pointed out, there are the non-banking products which are still required, and this is where we fill in, which is where NBFCs and AIFs fill in, and we're able to provide capital, whether from a greenfield stage to coming up with now the new solutions, because today it's not just about land buying, it's about JV, JDs, DMs, and so many other products that one needs, and this is where we're trying to fill the gap, but albeit with caution, because clearly it's about credit meltdown which may happen in any of the financial institutions across any of the platforms, which will obviously have an impact on all of us.
Right. So you think that now the other areas of funding could really find some way and find an opportunity for real estate
absolutely.
funding?
I think, we, in our discussion, Sanjeevji rightly pointed out, and he's also watching what funds are doing. And he's saying AIFs are growing at almost 40% per annum. It's a fact. NBFCs have overtaken banks in total exposure to real estate only in the last 4 years.
Right.
So clearly, I mean, what the banks have done for 40 years, NBFC has done in 4 years' time. So the speed of growth has been abnormal. And I think that is also right in a lot of ways. But having said that, I think there are things which are inevitable. One is that capital will get allocated in bigger chunks to fewer people.
Right.
The small chunk capital will not be going out that easily. And second, gradually the cost of capital is going to rise in the hands of people who are less credit worthy, or it may even disappear.
Talking about the alternate ways of funding, do you think private equity is doing enough?
Yeah, if you're looking at a long-term partnership, then it's a good option. There is no servicing of debt, the servicing of interest as far as equity is concerned. They do bring a lot of technology on the table. So they partner with you in the sense into the not only the financial partners, but they're also some of them are strategic partners. So it does help if you're looking at a very longer term relationship. Yeah.
So government had been working on RERA also because the real estate sector would become a little more palatable to foreign investors. What do you think about it? Is there enough money waiting on the sidelines to come to India in the real estate sector, and especially now when there is a dearth of funds from the NBFC side?
So, see, the money is definitely available. The thing is that if you look at the past, let's just step back. The first wave of capital actually came in obviously pre-Lehman, Press Note 2, 2005. From then we roughly have about $24–25 billion of capital which came in. Initial input of capital came in on the equity side, so we had preferred equity, we had compulsory convertible debenture structures largely coming in the country. But if you look back, the flight of capital which has gone back with the returns, that is roughly about $9 or $10 billion. So for that perspective, even on the post-Lehman, we had a lot of commercial office capital coming in, but they also yet to see the exits. We are hopefully that the first REIT would come in very shortly. So with that as a background, foreign investors definitely are cautious. So where has the capital come in over the last 3 or 4 years? Largely they found this NBFC structure, or let's say a AIF structure, which is more debt-oriented kind of structures, because they were comfortable in that, and therefore you had likes of a KKR, GIC, or a Lone Star, which is recent, or Mire, which is now getting into that space, which is roughly a $391 billion AUM company, which would be the top 10 in the Asian markets. So from that perspective, their first kind of round back of capital coming in is largely coming in from on the debt side. Obviously there are challenges on the debt side, which we talk about sometime back, and all the panelists, I agree with them. But having said that, because of a certain legacy, I do not expect a foreign equity capital coming in big hordes in the short term.
Just to add to that, so I think in terms of capital that has come in, I think there will be a requirement for even more capital in the next 5 years, the requirement wise, because of a few reasons. I think number one is the fact that customers' preferences have changed. Customers come in towards the end of the project and not as they used to come earlier. And therefore, there's an increased requirement of funding right through the project construction phase, which is why when we come in, we always make sure that the project is financially closed. And there's enough money to take the project and pour enough cement and steel such that customers come in and see when it's at a near finished stage. That's point number one. Second, the consolidation that's happening in the sector. There's a lot of well-funded, well-run developers. I'm not just saying big developers. Well-funded, well-run, well-managed, even mid-sized developers who are seeking funding for consolidation of weaker developers, land parcels, or doing JDAs with them, and so on. And that is another requirement of funds that would be sought from various kinds of financiers, including NBFCs and AIFs. And apart from this, obviously the kind of increased demand from customers that we have not seen over the last 5 years, which would happen, may not be over the next 1 year or 1.5 years, but it's a cyclical business and the cycle has to turn. I mean, it's a natural evolution. So there will be enough and more requirement. Now, obviously, I think this small turbulence that we have seen, small or mid-sized turbulence, time will tell, but there is enough and more sources of capital waiting and willing to come into India, of course at the right risk-adjusted pricing, because today the kind of pricing that a foreign investor gets if he comes into India on a risk-adjusted basis doesn't make sense, because one can get far higher degrees of pricing even within Asia, leave alone Europe or US. And therefore, if funds are constrained and there is less from NBFCs in the short term, and the interest rates move up a bit, there is enough and more capital waiting at the sidelines. So I think developers should not worry in terms of fund availability.
Ashok, you think developers should not worry, first, and second, your cost of funding increases. So will that be passed on to the consumers? Do you have that ability, because the demand has also been low?
There'll be slight cost added, okay? But as I said, we will go to NBFCs when there are different kind of structures. And ultimately, the blended cost will be not that great that we need to pass on to the purchasers. Yes, the margins, the developers who are process-driven, who are, consistent, who can sustain, will adjust this margin in their profits. So there's no need to pass it on to the consumers at all.
So Amit, do you think that there'll be a lot of opportunity because the prices will come down, and for alternate funds to come in and take advantage of that situation, and that will really fund the good projects?
So, clearly, I think it's heyday for alternate investment funds. I can tell you that. It started really in 2012. And I think in a very short period of time, Nisha, I think in a matter of about 6 years, I think we've already crossed close to 1.5 lakh crores of AUM, within AIF funds alone. And a bulk of it has come in the last 2.5 years. And I think it will actually double within the next 1.5 to 2 years alone. Currently for us, the largest opportunity, however, is what Ashok mentioned, is the entire dislocation, disruption and consolidation space. Yesterday I mentioned, to my estimate, there's almost $30 billion worth of stressed assets available in the country. Many of them through the banking space itself, several through NCLT and otherwise. And I think this is a huge opportunity for funds to go in and support the right developer.
So retail financing and housing finance companies have also been impacted in the current NBFC crisis. State Bank of India made a comment that they are going to expand this portfolio. How is that going to happen, and what are the targets there?
State Bank of India has been a leader in retail housing loan financing. As of now, if I look at it, amongst all scheduled banks, we have a share of around 33%, and in the industry, including NBFCs, HFCs, the share would be around 20%. So having said that, we also have steep targets for the year, and yesterday in this conclave itself, our Deputy Managing Director was here, and we had announced that this year we would be doing more than 100,000 crores of housing finance. And as Amit said, in affordable housing, we are totally involved and doing a lot of affordable housing. PMAY, yes, we are ahead of everyone. Recently, our Honorable Chairman was awarded by Prime Minister, Honorable Prime Minister, Mr. Narendra Modi, for having done the highest PMAY in MIG category. So we are on it, and we have lots of schemes to suit any kind of retail lending in housing loans.
All right, I think our government as well as the regulators will continue to put a watch on the present situation. But remember that when banks were not lending enough to the real estate sector, NBFCs took the opportunity, and right now if NBFCs pause for a bit, then somebody else could also take an opportunity. So we'll wait and watch out for that. But it's a pertinent question at this time. What will happen to the real estate sector, and what are the alternate modes of funding that real estate sector can really look into? With that, it's the close of this session. Thank you so much for being a great audience, and I really thank each of the panelists for their expertise as well.